Boomers, Vanguard says the party may be over. Hey everyone, Guy Midkiff here, and this is the Guy Midkiff Show. If you're a baby boomer, you've lived through one of the greatest stock bull markets in history, your retirement accounts may have doubled, maybe even more. But Vanguard just released a 2026 economic market outlook, and for people our age, well, I think it's a reality check. Let's take a look at it. They're projecting U.S. stocks to return only about 3.5% to 5.5% annually over the next decade, and that's a fraction of what we've gotten used to. And just a quick note, I'm not a financial advisor, a CFP, or a fiduciary. I'm a fellow boomer just like you, and I've managed my own portfolio since 1981. And what I want to do is walk you through this outlook and what it may mean to your retirement. This is education and opinion. And the whole idea is to help you ask better questions and not necessarily give you personal advice. I just simply can't do that, but I can tell you what has worked for me. Today, we're going to cover what Vanguard is really saying, why this hits baby boomers harder than 30, 40, even 50-year-olds, how to think about your plan using Charlie Munger's inversion idea, which I've adopted in my life some time ago, and my takeaways from the forecast. So if you're ready, let's just jump into this. What Vanguard is really saying. Vanguard calls this report, quote unquote, AI exuberance, economic upside, stock market downside. Okay, to me, that's a little bit of a gobbledygook statement. I don't really know what that means. So as I dug into it and I did my research, here's the items that I came up with. And to me, this is what's clear. There's a paradox that they've set up. They expect decent gross domestic product or GDP growth thanks to AI productivity. But stock prices are already in the 99th percentile of historic valuations. Let's talk about this in plain English. The economy may do fine, but U.S. stocks, especially big tech stocks, they're priced to perfection. So let's hit some of the forecast highlights projected in their 2026 release. U.S. equities overall will produce about 3.5% to 5.5% returns. Large cap growth, mega cap tech, 3% to 5%. Value stocks, small caps, REITs, for example, 6% to 8%. International development and emerging markets, that could be where the money is. And they're showing that in the 6 to 8%. And how about those bonds? They may be back in play after about a decade of being sound asleep, and they're calling 4 to 6% returns. So, if I may, this isn't a crash call. It's a lower your speed limit ahead sign. Why does this hit baby boomers harder than any other segment of our society? Well, if you're retired or close to it, risk works differently. And I've talked about risk on multiple occasions through several of my other past shows. I really recommend that you go back and look at them. But firstly, compounding slows. At 8 to 10% returns, money doubled in 7 to 9 years. But at 4 to 5%, it takes 14 to 18 years. And how about those sequence of return risks? Bad early years in retirement can permanently change your portfolio and do a lot of damage to it. Front-loaded cost, healthcare, for example, travel, family support. I've got 2 kids that are about to start medical school. All hit now, not later. We don't get 30 more working years to refill that bucket. That makes realistic expectations and diversification absolutely critical. Okay, can we really trust Vanguard? They've been doing this for about 10 years, so let's take a look at some of their past results. Yes, they've been too pessimistic before, like in 2015, when they forecast approximately a 7% return, and guess what we got? We got 13%, hallelujah. But their model is valuation driven, and that's a critical difference that I think we need to make. When prices are high, forward returns are lower. It's just a fact of life, it's gravity. I think the best way to look at it is to think of it as a speed limit sign and not a crystal ball. They're not telling you to go sell your portfolio tomorrow. I really want to make that clear. Given today's prices, expect slower returns. Historically, their relative calls, expensive areas underperform, cheaper areas outperform, have been broadly correct. Okay, why don't we talk about Charlie Munger's inversion idea and ask what would ruin your retirement and then avoid those mistakes. So the way we'll pitch this is what we could do that would ruin our portfolio and then the potential results. So the first one I would assume would be, hey, why don't we assume a 10% return forever, huh? That's great. Well, that would result in disaster. Flip it, stress test it at 4 to 5% returns on equities and maybe 3 to 4% returns on bonds. And I will do a complete show on how to stress test. It's much simpler than you would think. 2, concentrate only on hot U.S. growth stocks. NVIDIA. What's the regret? Well, flip it. Spread that risk to value, small caps and international. And by the way, Vanguard rarely represents that you invest in a single stock. As a matter of fact, I don't think they ever recommend that you invest in a single stock. Let's look at number 3. Hold no safe assets. That way you can be forced to sell low. What a great idea. Flip it. Keep several years of withdrawal cash in bonds or cash to protect yourself in the event that there's a precipitous downturn in the stock market. And let's look at the 4th idea, and certainly not the only ones that we could look at if we took more time. Take more risk than you need. How about that one? Stress for no benefit? Yep, flip it. Align risk with actual retirement needs. So let's quickly look at a couple of my takeaways. The first one I would say, and this is something I learned in the Marine Corps, and it's true in aviation as well, slow is fast. Don't overreact. Understand the situation calmly. Respect bonds again. We could be looking at 4 to 5% yields, and they could provide you a real safety net. Consider tilting towards value in international equities. Vanguard sees them as stronger lanes in the next 1 to 10 years. Keep 2 to 3 years of cash, if at all possible. I know that may be a stretch for a lot of us, but if you can do it, it'll buy you real peace of mind. Balance regularly. Trim your winners, add your laggards. Simple concept. Doesn't take a financial advisor to do that. Been doing my own since 1981. Side gigs. I have one. I'm not ashamed to say it. I work 5 to 6 days. I schedule for pilots. And I really enjoy it. Kind of keeps me in touch, and it gives me a little bit of extra income to ease the pressure. And I seriously don't want to touch my golden bucket that's got my hardcore retirement in it. Look at potential dynamic withdrawals. A lot of times you'll hear them talk about a fixed 4% withdrawal rate. Review that quarterly. If performance begins to lag, consider dropping it down to 2.5% to preserve your longevity. A bucket strategy, and I'm going to call these buckets like B1 through B5. So my bucket withdrawal order is B1, taxable cash. And luckily, I'm still in B1. B2 would be your IRA cash, such as the money market. Vanguard's got the VMFXX, which I think is around 4.1, 4.2% as of December 2025. Bucket 3 would be bonds. Bucket 4 would be IRA stocks, such as VTI. Vanguard never recommends specific stocks, nor do I. I'm not an advisor, but I'm just telling you, you can really be hanging it out there if you're just invested in NVIDIA, and I know a lot of you are. Bucket 5 would be your Roth. This is kind of like your final bastion. We don't want this to be your Alamo. This sequence that I've just discussed protects tax efficiency and keeps growth engines compounding the longest. Number 9, but probably not the only one in my takeaway, would be stress test lifestyles. Run various scenarios at low returns and higher inflation rates. If your plan begins to break down, adjust it now, not later. So I think this stress testing concept is so important that I've simulated a couple of stress tests myself. And the first one I did was I set a conservative return assumption. I use Vanguard's forecast as a base case. All right, this is pretty much what this show is all about. They're talking about U.S. stocks returning anywhere from 3.5% to 5.5% nominally. Bonds are in the 4 to 5% range. Inflation in the 2 to 3% range. Then build a stress case. What I chose was stocks at 3%, bonds at 3%. So kind of the worst case scenario here. Inflator at around 3.5%. This gives you a real return of about 1% on equities and bonds. That's your grinded scenario. Now, number 2, model your annual withdrawals. Instead of a fixed 4% rate, which you will see recommended quite frequently, a lot of CFPs recommend this, consider using a quarterly performance-based approach. Look back at the trailing 12 months portfolio performance. If returns are targeting below that, reduce your withdrawal rates anywhere to 2.5% to 3%. It's what I'm going to do if it happens to me. Cross fingers, let's hope it doesn't, but it most certainly will at some point. If returns exceed expectations, hey, you can flex up slightly or just keep the money in the bank. This dynamic approach helps preserve capital during weak years. Number 3, apply your bucket strategy. Withdraw in this order, and I've already talked about it, B1 through B5. B1, taxable cash, spend first, lowest tax impact. That's where I am right now. B2 will be your IRA cash in the form of VMFXX, which are money market fund. Next layer, and it's still liquid. B3 would be bonds, stable income generating. B4 would be your IRA stocks such as VTI. This is the growth engine of your portfolio. It most certainly is mine, and I rarely want to touch this if I don't have to. Tap only when needed, all right? Bucket 5 would be Roth. Hey, that is your anti-Alamo bucket, if you know what I mean. Preserve that for last. Tax-free growth is your ace in the hole. This sequence protects growth assets and minimizes tax drag. All right, number 4, run a 10-year projection. Use a spreadsheet or retirement calculator. There's one, I think it's called New Retirement or Prolana, Gold, or even Vanguard's own tools to simulate. I can put some links down below, or at least how you can find these various sites. I actually use AI to run mine, and I've talked about it before, but I use the 6 primary AI engines from Grok to Copilot and all AIs in between. That's how I run my simulation engines. Your portfolio balance over 10 years, withdrawals adjusted for inflation, market returns in the 3 to 5% range. Let's not forget about healthcare and lifestyle costs rising anywhere from 3 to 5% annually. And we're really hoping we get that fixed in 2026. So if your portfolio shrinks too fast or hits critical depletion before 85 or 90, hey, that's a red flag. Now let's take a look at number 5. Test shock scenarios. Add in a 25% market drop in year 1. This would be your sequence of return risk, or the SORR. Let's look at a 5% inflation spike for 2 years. Unexpected $50,000 to $100,000 expense, such as a family emergency or, God forbid, a medical emergency. See how your plans hold up. If it breaks down, consider reducing discretionary spending. Delay large purchases, increase bond allocations, or your cash buffer. Number 6, stress testing isn't one and done. Revisit it each year. Update market returns. Adjust inflation rates. Recalculate withdrawal rate. Rebalance your buckets. And as we're approaching the end of this show, just remember my 2 bylines. First one is health is wealth. You can't really enjoy your retirement if you're in poor health. Get out there and get your 10,000 steps in a day. And also, let's go get busy living. Thanks for listening to me. I do talk about a broad range of items, so go back and take a look at my shows. I appreciate it. If you have ideas for shows, please let me know. Just throw them right there in the comment section. Again, thanks for listening to the Guy Midkiff Show, and you guys have a great 2026.